Hi and welcome to the Martin Bell Show. Hopefully you've been keeping well, and in the video today we're going to be reading from the Daily Mail Online from the money section of this newspaper. Before I do go any further, I would like to branch out and use other newspapers as well, but at this moment in time the Daily Mail does have some good articles on the money section of this newspaper, but I will be browsing into other newspapers as well, just to make you aware. So it says here, can home bias boost your ISA thanks to better knowledge, or will favouring the UK hold your investments back? So personally, I do, before I go any further, I am not a licensed professional. I am just documenting my journey for inspiration and motivational, educational purposes only. Please do your own due diligence before making any investment decisions. So home bias offers some natural advantages in terms of local knowledge and being invested in your own currency. But there are clear downsides to focusing too narrowly on the market, which defies the usual investing wisdom to spread your risk and cut you off from valuable opportunities. Well, the FTSE 100 is a very international companies. It's not just UK companies, they're very global. And the top ones are very international as well. So it's not really a UK play. The FTSE 250 I think is more of a UK play than the FTSE 100. So it says here, we asked financial experts how investors should approach splitting an ISA portfolio between the UK and the rest of the world. So they discussed the pros and cons of home bias, how much domestic exposure is about right, considering the UK only represents around 5% of the world market, and whether it's a good time to be overweight in local investments. What are the advantages of home bias towards the UK? Knowledge. It's not a bad thing to know and understand the companies you invest in, which is often the reason why investors skew their portfolio towards the home market at the expense of other regions, says Ed Monk, Associate Director of Personal Investing at Fidelity International. Special features: the risk from home bias is reduced somewhat because of the UK market includes many large companies which earn their money around the world, known as Monk. He says as much as 70% of the earnings of the FTSE 100 companies are made overseas. So when you buy a slice of the UK market, you're actually getting exposure to growth in many other economies as well. Monk adds that the UK market has high exposure to sectors like commodities, financials and consumer staples, and that's one reason why I'm investing into the FTSE 100, because there's different sectors compared to the S&P 500, which is more into technology sectors. So that's why I'm also moving into different sectors and geographical locations as well. So for example, he says home bias worked in investors' favour for several years after financial crisis, but the picture has become less rosy in the past few years as the rapid rise of US tech companies has left the UK's in its wake, including during the pandemic. But that's not always true, but the UK does pay a juicy dividend compared to the S&P 500. Dividends. The sectors mentioned above have also historically paid a good income, which has made the UK appealing to many small investors, says Monk, that might either want the income or like the stability that dividends provide to a total return when they are reinvested, he explains. Personally, I'm not a fan of growth stocks. I'm more interested in dividend and income stocks, because the only way to make your money is to either sell it down the line for a greater amount of money. So, Ian Brans, head portfolio management at Net Wealth, points out that the large UK stocks represented by the FTSE 100 now offer twice the level of dividend yield as the US stock market. There you go, what did I just say? In the US, companies tend to reinvest their profits more readily for the future growth rather than distribute them to the investors, he says. So this is another way of, if you want some growth, maybe go more into the S&P 500. And then if you want some more income, maybe go into the FTSE 100. There is another one I am looking into, which is O-Shares, Kevin O'Leary's OShares US dividend quality income or something like that, and basically they're carefully selected with that are not likely to be knocked if it's a downturn, and they do pay all dividends. They're only interested in paying dividend paying stocks, and it's a monthly paying ETF as well. I think it's around 4 to 6 cents per unit held. So if you snowball that over periods of time, it really does add up. So currency management is the key to prospective returns, and UK equity allocations are an effective lever to control exposure to currency risk, according to Barnes. Investing on an international basis brings either an additional layer of currency risk or an additional cost to hedging, he says. That said, looking under the bonnet of a UK fund is the key to understanding where many of the global companies that make up the FTSE 100 earn their revenues, as that will influence the dynamic between currency movements and company share prices. Opportunity. A high international weighting over the past 10 to 25 years has made little difference to a portfolio volatility, while giving one access to a much wider universe of stocks, says Rupert Thompson, Chief Executive Officer at Kingswood. Will Hobbs, Chief Investment Officer at Barclays Wealth Investment, says, geographical bias not only limits you opportunities but also skews a portfolio towards certain sectors and styles, which can have a significant impact on performance. The more narrow your fashion, your investment net, the more likely you will miss or partially gather the income from profits haul. The other linked point is associated with risks. Not only do you narrow your return horizon by focusing on the overly familiar, but to concentrate the idiosyncratic risks you are exposed to, political, economic and beyond. Winners. Thompson says the UK investors with a greater international weighting in their portfolio would have a more exposure to big winner of the last decade, the tech sector, in which he says the UK is woefully underweighted. Well, yes, I think maybe he's more tilted towards the growth income. I am more interested in growth, some growth income, but also wealth preservation, but also has some cash flow. If it doesn't cash flow, just say no. So, in history has shown that the new technology sector breakthrough could come from anywhere at any time from anyone. As such, focusing on one particular country, sector or company may inhibit your return prospects, says Hobbs. But also, as the economy reopens, the tech sector has had a nosedive. If we look, we can see it has gone down. When was this article written? 24th of May, so it is today. But as the economy reopens, the tech sector will take a hit, and I think QQQ has taken a massive hit in its ETF because it's mainly a technology sector. They have taken a massive hit, and there's more volatility, and that's the reason why I want to go into the Kevin O'Leary's high dividend American companies, because when there's a recession or a downturn, it takes less of a hit than compared to the S&P 500. So how much would you allocate to the UK? Well, this decision to overweight in the UK is important. An equal crucial but sometimes overlooked consideration is the appropriate neutral allocation to base an overweight on, says Thomas. The UK now accounts for no more than 4% of global equity index. A critical judgment is how large home bias is justified. We believe that an appropriate neutral UK allocation is no more than 25%. And I would disagree that in general, I would never do more than 20% then 25% in like a sector in general. To me, I wouldn't go over 20% in a sector personally. I like what Kevin Nero says. And if you're going to do single stocks, I would never go much beyond 5% in a single stock of your entire net worth that is invested, because there's a lot of more risks, and then you may not get as good as gains, but you also stop the drops as well. So Ed Monk of Fidelity says that while the UK only makes up 5% of the global stock market by value, many investors would see that as quite a low exposure to the home market. He puts the proportion of investors should aim for just above this, saying between 5 and 10% is a typical allocation. I would say that's a bit rich, but oh no, I'm talking about I think it's talking about the ETF for FTSE 100, so that's okay. 5 to 10% is pretty good. So if you're confident in the UK, an allocation at the top of this range with a tilt towards mid and small size companies makes sense. But if I'm going to go small size companies, that is very more risky. There is more potential upside, but obviously there's more risk involved with that as well. Some companies will go to zero because there's more risk involved. So is it a good time to give a heavier weight into the UK? The UK market is cheap compared with the rest of the world, and the economy is on the cusp of a sharp rebound after the rapid vaccine rollout. That said, with 75% of the FTSE 100 revenues coming from overseas, the primary reason for overweighting the UK is its cheapness. And yes, it is. The iShares FTSE 100, which I own, so for every 10 grand I put in, £7 is taken out. So that makes me a very happy boy. So the primary reason for overweighting in the UK is its cheapness. So iBurn says at the moment that wealth portfolios are exposed to the small and medium-sized companies in the FTSE 250. Political uncertainty and sluggish economic growth have caused international investors to ignore these companies, which are geared towards a domestic outlook that we think is now improving. But I think a lot of people do like the S&P 500 because they're like, oh, I can make a quick buck. Dividend investing is a long, slow growth, has some growth, some capital appreciation growth, but it's not a quick get rich scheme. Dividend investing at all. It's a long, drawn out process, but it does work out really well. If you look at the history of it, dividend investing has worked out the better. Dividend paying portfolios and dividend paying stocks do outperform non-dividend outpaying stocks. So the IMF expects a 5.3% rise in GDP this year, faster than for advanced economies generally. UK shares are cheap, however you choose to measure them against earnings, assets, and notably when compared with dividends, and after the last year's cut in payouts, home bias to UK may not be the worst idea. So let's see what they say. The best rated ones. Not that great. So that's just something to think about. So yeah, what is it? The iShares FTSE 100, which is a ETF by iShares of BlackRock. It pays about 6p every quarter, so 2p every month. And I know it's only 2p, and you say that's only 2p if you have one of them, but if you slowly build wealth and then you have like thousands of them, and then potentially have like tens of thousands of them, and then maybe you have 100,000 of them, it does start to add up and build up over periods of time. It's not because something happens overnight. You've got to have fortitude and strength of character, and you have to sacrifice and make sacrifices in life, and then your later rewards in the future. So hopefully you found this video useful and informative. I'll be interested in hearing your thoughts below. Are you into home bias or investing more into the FTSE 100? Or if you're in a different country, are you in home bias or are you more international? I'll be interested in hearing your thoughts and opinions. As I said, I roughly have around 283 units of that FTSE 100 at 6p, and let me just let you know what it makes, just to make you aware. So that's around £17 every quarter. So it does work. It takes time, and then once you can get dividends and reinvest in it itself. It's called a drip, and this time round, I'm going to get around 2 units from dripping into itself, plus whatever I add additionally, and this builds up over periods of time. So this is why it's very important to get your finances right, work on self-development, improve the mental states of mind, making the right habits, cutting out bad habits, toxic habits for the mind, and making self-improvement and making your life better for yourself, your family, your local community, and the causes that you believe in. So thank you very much for watching. Take care, and I hopefully you all have a good day.